Now let's turn to Lesson 2. Our objectives for Lesson 2 are to ultimately understand business unit performance measures, profit as a measure of performance, consider return on investment as an alternative performance measure, and think about a more economic view of performance. So why is financial performance measurement so important? Well, an implication of decentralization is that large organizations are organized into different units or departments. And so we need to keep those managers and those departments accountable because those managers are provided with decision-making rights. So you might think of the generic firm as one involving an upper corporate or executive level. And then there perhaps are multiple business units that report to that corporate executive level. Maybe more than two in many firms, but for our purposes, we'll just talk about these two. And then within Business Unit 1, there are multiple departments, Department 1A and Department 1B. Obviously, this is the hierarchy of the firm, and there are managers and employees that work at each of these levels. Financial performance measurement allows for us to compare these different departments and business units to each other, as well as other business units that might be acquired or might be disinvested as well. So financial performance measurement tells us the story as far as how well the business units are doing in terms of achieving the organization's goals in terms of profitability. So continuing this discussion, financial performance measurement measures progress towards organizational goals. But what about not-for-profit organizations? Those that the primary goal is not necessarily to increase or sustain profits, but rather some other social consideration. Well, profitability and financial performance measures are just as important to those not-for-profit. It allows the not-for-profit to achieve its goals if it brings in enough resources in order to engage in the activities for which it charges itself. So ultimately, the financial performance measures tell a not-for-profit whether or not their current business model is sustainable going forward. So just because profitability is not the main goal does not mean that financial performance measures lack importance. Now, in terms of thinking about profit as a financial performance measurement, there are some problems associated with it. First off, it's accounting period specific. How financial accountants calculate profit is for a specific time period. It can be as small as a day or a week, or perhaps a month, a quarter, or a year. But nonetheless, it is accounting period specific. So it's limited in terms of its scope. It can also be manipulated. Real decisions made by managers might be made to just increase profits for a given time period. And sometimes those decisions are dysfunctional. Other times we can just record things how we want to and make profit look better or as we want it to be for a given time period as well. This manipulation is dysfunctional in a sense. And so when we rely on profit, it's not always the best representation of what actually went on. It's one of many goals. Profits are perhaps an important goal for many organizations, but it's not the only one that it has. So it's rather incomplete in terms of encompassing all of the important organizational goals that the firm has. And finally, it's not completely diagnostic. Just because profits go up in a given time period does not mean that that increase is sustainable or was brought about by desirable means. So profit just tells us the end of the story. It doesn't tell us really the how that the profit actually went up. So these problems with profit lead us to consider other financial performance measures that complement this in helping us facilitate and guide decisions.